Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. So this past weekend, I spent a couple of hours to do something I've been meaning to do for a while. Read Howard Marks's latest memo. This one was all about artificial intelligence. For those who don't know, Howard Marks is the co-founder of Oak Tree Capital, and his memos are these legendary, thoughtful pieces on markets and investing. They are not quick reads, but they are always worth it. And this one did not disappoint. It felt like a masterclass in how to think about a technological revolution, especially when you've got capital on the line. It confirmed some of my own nagging thoughts, but more importantly, it gave me a brand new framework that just clicked. It sorted the chaos into a much clearer picture. So I wanted to walk you through my biggest takeaways, and I have split them into two parts. The brand new insights that sort of changed my perspective, and the ones that I already knew but acted as strong reminders nevertheless. Oh, and stick around to the end because I will share what I think is the only pragmatic path forward for investors in this wild AI moment. Let's start with the new stuff, and this is the big one. Howard Marks draws a crucial distinction between two completely different kinds of bubbles. He calls them inflection bubbles and mean reversion bubbles. This was a game changer for me. An inflection bubble forms around something that is genuinely, foundationally transformative. The classic examples: the railroad mania of the 1800s and the dot-com boom of the 1990s. In these cases, yes, you get insane investor frenzy. Capital floods in, valuations go to the moon, and a ton of money gets incinerated in failed ventures. But the world does not snap back to how it was before. The core technology, railroads, the internet, proves to be real and world changing. The bubble, in a messy, wasteful, and often painful way, acts like a massive rapid experiment. It's like carpet bombing the field of future with capital. It accelerates development by decades. Now, the internet did not die with pets.com. It became the backbone of everything. A mean reversion bubble, on the other hand, is built on sand, financial engineering, flawed assumptions, pure speculation, with no lasting change underneath. Think the 2008 housing crisis or the South Sea Company bubble centuries ago. Here, the market soars on an illusion, a new miracle, and then collapses violently, destroying wealth and leaving little of enduring value behind. It's a return to the mean, hence the name. Now apply this framework to today. Marx is clear, and I agree. The AI frenzy is almost certainly an inflection bubble. As he puts it, he has not met anyone who does not believe AI could be one of the most significant shifts of our lifetime. The potential to reshape productivity, creativity, and whole industries is palpably real. This leads to a fascinating, almost heretical idea. Some bubbles can be good. From a long-term society perspective, the frenzy compresses what would have been 30 years of gradual investment into a frenetic 5. It is wildly inefficient and hurts a lot of individual investors, but it can catalyze a world-changing technology at breakneck speed. It's a reminder that the cautious value investing mindset, which is focused on preservation and measurable worth, is great for protecting capital. But it's often the speculative animal spirits that build the new thing. Okay, so the bubble might be the productive kind. That's the exciting part. But here's where Marx shifts from observation to essential caution. And this powerfully reinforced what I've always believed about technological revolutions. The uncertainty is absolute, and it's an investor's minefield. First, picking long-term winners is brutally hard. He uses the classic auto industry example. In the early 1900s, everyone knew the car was revolutionary. Yet, of the roughly 2,000 companies that jumped in, Only a tiny handful survived. The technology was real, but the victors were impossible to identify at the start. Today, while certain giants seem like sure shot winners, history screams that there's absolutely room for a new unknown entrant to disrupt the entire landscape. Second, and this is critical, who actually captures the profits is wildly unclear. Where will the vast economic value of AI actually reside? Will it be the foundational model makers like OpenAI or Google, the hardware kings like Nvidia, the companies that build specialized applications on top? Or, and this is key, will it be the end user businesses that simply use AI tools to slash costs and boost their own productivity, keeping the profits for themselves? Well, it's entirely possible that the creators of the technology end with less profit than today's sky high valuations imply, while the users reap the bounty. Third, Marx points out some worrying financial dynamics already creeping in. Circular deals where one AI company invests in another, inflating valuations, and the dangers of debt and high interest rates in a speculative sector. So we have a potentially world-changing inflection bubble shrouded in immense uncertainty. What do we do? Go all in or sit on the sidelines? Marx, in his wonderfully balanced style, does not pretend to have a crystal ball. Instead, he offers what I think is the only sane advice. I will paraphrase his conclusion. He says, and I quote, "Since no one can say for sure if this is a bubble, no one should go all in without admitting they risk ruin. But by the same token, no one should stay all out and risk missing one of the great technological leaps forward. A moderate position applied with selectivity and prudence seems best." Well, this resonates deeply with me. My natural habitat as an investor is not a hot speculative sector. I am drawn to undervalued stocks with a wide margin of safety, something nearly impossible to find in today's AI space, glowing with optimism. But Marx's memo is a vital reminder. Total avoidance is also a risk, the risk of missing a defining shift. The key is not to abandon your principles, but to adapt the application. You can consider investing in AI, but you must do it with extreme selectivity and prudence. Here's what that means. Position sizing. Any investment in a high uncertainty AI stock should be a small, carefully sized part of your overall portfolio. This strictly limits the damage if you're wrong. Rigorous research. Go beyond the hype. You must understand the company's specific path to profitability, its real competitive moat, and whether its valuation has any sane connection to realistic future cash flows. If you can't answer that, it's not an investment, it's a lottery ticket. Humility. Accept that even your best analysis could be wrong. The future is opaque. And you know what? History is comforting here. Think of Warren Buffett and Peter Lynch. They missed entire waves. The rise of the personal computer, the early days of the internet. They still generated legendary returns by sticking fiercely to what they understood. Their success was built on prudence and not prophecy. In the end, Howard Marks's memo gives us the perfect balance framework for the AI era. Acknowledge the transformative potential, respect the immense uncertainty, and never ever let excitement override discipline. The goal is not to be a prophet. The goal is to find a way to thoughtfully participate in progress without jeopardizing your financial survival. It's about having a seat at the table of the future without betting the farm on a single unknown chair. Thanks for watching. I'd love to hear your thoughts on this balancing act in the comments below. Are you leaning in, staying out, or taking that selective, prudent middle path? Let me know. I'll see you again. Goodbye and happy investing.